Welcome back to Investing Talk Podcast. Today we're zeroing in on a major player in the food sector, specifically the egg market. We're looking at Cal-Maine Foods' upcoming earnings to watch. Our goal here is to cut through all that data clutter, the pre-earnings reports, the analyst notes, and really...
Yeah, exactly. So we're talking about fiscal Q4 2025 results. That's the quarter ending May 31st, 2025. Now, the official release date isn't posted yet, as of when we looked, September 22nd. But, typically Q4 results came out around July 22nd last year after the market closed. That was their usual pattern.
Right, standard procedure. So what's the big shift?
Well, what's really different this time is what happens after the numbers drop. Cal-Maine has scheduled its inaugural quarterly earnings conference call and webcast for October 1st.
Wow, their first one.
Yeah.
For a company like Cal-Maine, that's huge. They've always been known for being pretty quiet, right?
Yeah.
Almost privately controlled and feel.
Exactly. They were a controlled company on Nasdaq until just recently because of their stock structure. So this call, it's a major step. Proactive investor engagement like we haven't seen from them before.
Okay, but I have to ask, why now?
Oh.
Is this genuinely about being more open, maybe signaling a new phase? Or could it be, managing expectations, getting ahead of potentially tough news, especially with egg prices normalizing?
That's the million-dollar question, isn't it? It could easily be a mix of both. Look, their whole government structure has changed fast. That almost demands better communication. But at the same time, yeah, they are facing some really tough year-over-year price comparisons. Those are going to look rough on paper, no matter how well they manage things operationally.
So the call gives them a chance to frame the narrative.
Precisely. They get to add context immediately instead of just letting the numbers speak for themselves. It feels like corporate maturity, maybe, but the timing definitely suggests there's some necessity driving it too.
And that necessity aspect is important because, as you mentioned, they operate in a bit of a guidance vacuum. They don't usually give explicit quarterly forecasts.
That's right. And as of our sources, still no Q1 fiscal 2026 guidance provided.
So analysts are essentially, flying blind, basing estimates on industry data, commodity prices, history.
Pretty much. And because of that vacuum, the analyst forecasts they're all over the place. Let's start with revenue. The consensus is sitting at about $665.4 million.
Okay, a big number, but how does that compare?
Well, that's where it gets tricky. It actually represents a year-over-year decrease of around 3.2%.
Down 3.2%.
Oh, okay.
And the earnings per share. I suspect that comparison is even tougher.
Oh, it is. The consensus EPS is $1.15, JAP. And you compare that to Q4 2024. They reported an incredible $2.27 back then.
Wow, $2.27 down to a projected $1.15. That's cycling against a peak, isn't it?
That's exactly the phrase. They're cycling against a period of extremely high pricing.
Which basically code for. Last year's numbers were kind of inflated because of the avian influenza supply shocks, and now prices are, coming back down to earth.
You got it. They benefited massively from lower industry supply and those price spikes. Now, the supply chain's mostly stabilized. That's a key point from the data. So now they have to compete more on volume and cost control, not just crisis pricing.
Which explains why the analyst estimates are so spread out. How wide is that EPS range you mentioned?
It's pretty wide. The low end is $0.89, and the highest estimate goes up to $1.36.
Dilly $8.89 to $1.36. Yeah, that shows a lot of uncertainty about where those selling prices and input costs actually landed.
Definitely. And not only is the range wide, but the recent trend in those estimates hasn't been great.
Moving lower.
Yeah, a clear downward drift just in the last month. EPS estimates are down about 2.6%, and revenue estimates are down 1.4% over that same period.
And the reason?
The notes clearly point to lower egg price prints recently. That data is filtering through, making analysts a bit more cautious, maybe less confident about hitting the higher end of their models.
Still, even with downward revisions, you can't just assume they'll land right on consensus. This company has a history of volatility, right?
Oh, absolutely. That's the nature of trading a commodity stock like this. In the last 4 quarters, they actually beat EPS estimates 3 times, only missed once.
So they often find a way to surprise.
They do. But even when they beat, the stock reaction can be all over the map. We've seen one-day moves from positive 7.8% after one beat down to negative 5.2% after another. Investors really need to brace for that kind of swing.
Okay, so to understand that potential swing, we need to dig deeper than just revenue and EPS. Let's talk operational metrics. Specifically, margins. That seems like the key.
It really is. Gross margin is the critical one to watch. In Q4 fiscal 2025, their gross margin was actually 22.1%.
Wait, 22.1%? That was up year over year. How did they manage that if selling prices were normalizing downwards? That seems counterintuitive.
It does, but two things worked in their favor. First, feed costs dropped quite a bit, which lowered their cost of goods sold.
Okay, lower input costs.
Yeah.
Makes sense.
Second, the company showed really good supply discipline. That helped offset the slightly weaker average selling prices, or ASPs. And this really brings us to that core conflict in the egg market right now.
Yeah.
Strong volume versus weaker price.
Let's confirm the volume part first. They are selling more actual dozens of eggs.
Yes, absolutely. Dozens sold were up 2.9% year over year in Q4, reaching 322 million. That strength comes from gains in retail generally, and also their continued success in grabbing more of that cage-free market share. So unit strength is there, demand seems solid, but the price they got per dozen.
That's the other side. The average selling price was down 6% year over year to $2.05 a dozen in Q4. That's the normalization effect after those avian flu price peaks we talked about.
Okay, and this is where that sensitivity comes in. For a company with high fixed costs housing, feeding all those hens, even a small change in the selling price per dozen can have a massive impact on profit, right?
You've nailed the single most important point, technically speaking. The sensitivity is incredible. Look at the numbers. Every single 10-cent drop, just $0.10 per dozen in their average selling price, translates directly to about $30 million in annual EBIT, earnings before interest and taxes.
$30 million from a dime swing per dozen. Wow. Why is it so leveraged?
It's because their biggest costs, feed and housing, they're relatively fixed in the short term. They don't just automatically drop because egg prices dip 10 cents. So when your ASP slides, that lost revenue basically punches straight through your gross margin line. It hits EBIT almost dollar for dollar. Okay, got it. So given that huge sensitivity, gross margin and the ASP trend are really the absolute key metrics to watch in this report.
Without a doubt. If ASPs held up better than those recent downward revisions suggest, the earnings outcome could be significantly better than expected.
And we should probably add the seasonality context here. Q1 isn't typically their strongest quarter, is it?
No, generally not. Q1 tends to be seasonally weaker for both egg sales and margins. You have fewer big holidays compared to other parts of the year, so demand slows a bit. Plus, you can sometimes get noise in summer input prices for feed, which could potentially squeeze margins a bit from that 22.1% level we saw in Q4.
So lots of commodity cycle risk. But Cal-Maine is also trying hard not to be just a pure commodity play anymore, right?
Yeah.
Let's pivot to the recent catalysts and structural shifts.
Yeah.
They seem to be painting a different picture for the future.
Yeah, that's clearly the strategy. And the biggest recent move on that front is the acquisition of Echo Lake Foods.
Right, the ready-to-eat egg products and breakfast foods company. They paid, what, about $258 million?
That's the number. And this is definitely a strategic play to diversify. Get away from relying solely on shell eggs. Move into higher margin, value-added prepared foods. Those are generally less vulnerable to the wild commodity price swings we just discussed.
Makes sense. Less volatility, potentially better margins. Is it expected to help earnings soon?
The projection is for it to be mid-single-digit accretive to earnings by fiscal 2026.
Yeah.
So, yeah, fairly quickly. Accretive just means it's expected to boost their earnings per share, suggesting it's a profitable acquisition that justifies the cost. It definitely helps dilute that pure play egg risk.
And alongside the M&A, the governance changes have been huge too. We mentioned the first earnings call, but the whole structure of the company has really changed.
It really has. You had the conversion of all that Class A common stock into regular common stock. That meant they stopped being a Nasdaq-controlled company.
Which matters because
it makes the stock more appealing to big institutional investors. Many of them have rules against investing in companies where voting control is locked up with insiders or a founding family. This opens the door to them.
Okay, so more potential buyers for the stock.
Mm-hmm.
But here's where I see a potential conflict, or at least something investors need to think about. We see this big investment in Echo Lake. We see commitment to shareholders through capital returns. But then the insiders are selling shares.
That is the crucial tension, yes. At the same time they're making these seemingly positive corporate moves, we saw a major insider shift. The founders' family members did a secondary offering selling nearly 3 million shares back in September.
3 million shares. That's a lot. It reduces the family's exposure significantly.
It does.
So if management is bullish, buying companies, buying back stock, why are the founders selling so much? Is that a red flag? Or just normal estate planning or diversification after holding the stock for so long, especially after that price run-up during the avian flu crisis?
It's probably a mix of things. With long-held family stock, diversification and estate planning are common reasons for big sales, but the market never likes seeing significant insider selling, whatever the stated reason. It often reads it as a lack of confidence. And the optics get even more complicated when you see the company simultaneously returning a lot of capital. They declared a huge cash dividend, $3.46 per share, and they started executing on a new $500 million share buyback program.
So they're using company cash to support the stock price, effectively, while the founding family sells into that support.
That's one way to interpret it. It's definitely an unusual balance. It suggests management is confident in their cash flow generation, even as insiders reduce their personal holdings.
Interesting dynamic. Okay, switching back to the sector level, things seem relatively stable lately. No major disruptions like last year.
Yeah, the sources indicate stability, at least in the immediate past. No new reports of major avian flu outbreaks or significant plant disruption since Q4 ended. That helps ensure volume consistency. And that broader shift to cage-free eggs, it's just steadily moving along. It hit 47% for branded retail as of August. That's a long-term tailwind for Cal-Maine, given they're a leader in that premium segment.
Okay, so summing up, stabilizing volumes, potentially volatile margins because of ASP sensitivity, aggressive M&A, and this complex insider selling versus buyback story. What's all that done to the stock price recently?
Well, it's created a lot of uncertainty, basically, and that's led to a pretty choppy technical picture. The stock's been stuck in a fairly tight consolidation range, bouncing between roughly $51.10 and $54.75 for the past 4 weeks or so.
So investors are kind of holding their breath, waiting for earnings to give some direction.
Exactly, just waiting for the actual numbers to break it out of that range one way or the other.
And what's the options market saying? Are traders betting on a big move?
They certainly are. Implied volatility, or AVA, is quite high, sitting around the 68th percentile.
Which means
Options traders are definitely expecting a larger than usual price swing around the earnings release. If you translate that AV into an expected move, the market's pricing in roughly plus or minus 5.6%.
5.6%, so around $2.90 either way, based on recent prices.
Yeah, about that. That high implied move reflects all the uncertainty we've been talking about, those tough year-over-year comparisons bumping up against that extreme ASP sensitivity.
Given all that, what's the general vibe from the analysts you track? What's the consensus leaning heading into the report?
Overall, it feels neutral to mildly bearish. That's mainly driven by those downward estimate revisions we talked about earlier, and really just the shadow of those incredibly tough YoY comps from the avian flu peak last year. Expectations seem pretty tempered right now.
Okay, so let's try and put some probabilities on potential outcomes for listeners thinking about their next move. What's the base case?
Right. The base case, let's give that maybe a 50% probability would be an inline result. Something like EPS coming in between $1.08 and $1.18, and revenue landing somewhere between $658 million and $672 million. Basically, meeting those slightly lowered expectations.
And the likely stock reaction in that case?
Probably fairly muted, maybe a move of plus or minus 4% to 6%. It would likely keep the stock trading within the recent consolidation range. No big breakout.
Okay, what about the bull case? What would drive a positive surprise? Let's say 30% probability.
The bull case would likely need a real positive surprise on margins. Maybe ASP is holding up much better than feared. Or perhaps stronger unit volume than expected, maybe showing some early positive contribution from that Echo Lake acquisition. You'd be looking for EPS coming in strong, say between $1.25 and $1.35.
And the market reaction to that.
A beat like that could trigger a sharp positive move, maybe in the range of plus 6% to plus 12%, as the market might have to quickly reevaluate their profitability assumptions upwards.
And the downside, the bear case, maybe 20% probability. What drives that?
The bear case is almost entirely about those average selling prices slipping faster than expected. Or perhaps an unexpected jump in feed costs that really squeezes that crucial gross margin. If EPS were to come in weak, say between $0.90 and $1.05, you could definitely see a significant negative reaction, maybe an 8% to 12% drop in the stock price. That pricing sensitivity makes the downside risk very real.
Okay, so it really circles back to that core issue.
It really does. To summarize everything, the single most critical thing to watch in this report is that gross margin figure and the underlying average selling price trend. The unit volumes seem okay, even strong, helped by their cage-free position. But pricing is the absolute wild card. It's what will likely determine whether we see the bull or the bear scenario play out.
So here's the final thought for you, the investor, to really chew on as you process all this. We've seen this company go through a massive transformation recently. They're not a controlled company anymore. You've got significant insider selling happening. And crucially, they're boosting transparency with this first-ever earnings call. So think about this confluence of events, a new capital structure, this newfound management openness, aggressive shareholder returns, but happening alongside large insider sales. It puts them at a huge strategic crossroads. Is this combination setting the stage for future shareholder activism, maybe from those large institutions who now have more voting influence? Or is management just paving the way to make even bigger acquisitions in that prepared food space, trying to finally shed the volatility of being a pure egg commodity play? That underlying tension is the next big story to watch here. Thanks for joining us for this analysis. Remember to keep learning and stay well informed. We'll catch you on the next one.